This is session 2 of the Foundations of Finance module. In this session, I'd like to talk about the way we think about a business in finance and lay the foundations for what I call the corporate life cycle. A concept I'm going to come back to over and over again in the course of both my corporate finance and my valuation classes. So let's think about a balance sheet. A balance sheet as seen through the eyes of somebody in finance as opposed to accounting. An accounting balance sheet, as you know, accountants break down assets into fixed assets, current assets, intangible assets, financial assets, and on the liability side into current liabilities, long-term liabilities, shareholders' equity, and God only knows what else. In a financial balance sheet, as you notice, there are only two items on each side of the balance sheet. Let's take a look at the asset side of the balance sheet. In finance, we don't care about whether assets are fixed or intangible or current. We care about whether they're in place, they're already there, or whether they will show up in the future. Assets in place and growth assets. Assets in place are investments you've already made as a company. Growth assets is the value that I'm giving you because I think you'll make investments in the future. Next year, 2 years out, 5 years out, as far as the eye can see. Scary. I'm giving you credit for investments you haven't even thought about yet. On the other side of the balance sheet, notice there are only two items. There are only two ways you can fund a business. You can borrow the money, that's debt, or you can use your own money, that's equity. So let's take a closer look at each of these items because in a sense it's going to lay the foundations for almost everything we do in finance. Let's start with assets in place. As I explained, assets in place is the value that I'm attaching to investments you've already made as a company. Let's provide let's think of a couple of examples. If you think of GM or Ford, old-time automobile companies, assets in place will be the automobile plants, the assembly plants, the production that they already have in line. If you're talking about Microsoft, assets in place will be Windows and Office, investments that Microsoft has already made as a company. You're saying, how is this any different than what accountants are doing? Here's the big difference. In finance, when we think about assets in place, the question I'm asking is not how much money have you put into these assets. You might have spent billions and billions in these assets, but frankly, I don't care. What I'm talking about is the value that I'm attaching to these assets based on what they will produce in cash flows in the future. Already you can see that there can be a disconnect. Disconnect between what you've invested in an asset in place and the value that I attach to it. In fact, if you've invested a lot in assets in place that are no longer producing much in earnings, the value that I might attach to those assets in place might be much lower than the number you show on your accounting balance sheet. If the assets in place have become much more productive, the value that I can attach to those assets in place might be much greater than what you see as capital invested. If they're kind of running in place, if they're doing what they did when you originally invested, they might be close to what you show as capital invest in your assets in place. So what you see as the value of assets in place in a financial balance sheet is not a reflection of what you've already spent on these assets, but on what I expect you to generate as value from these assets going into the future. It's forward-looking, not backward-looking. That concept gets even more interesting when you think about growth assets. Growth assets is the value that I'm giving for investments I expect you to make in the future. Next year, 2 years out, 5 years out, 10 years out. The value of growth assets comes not from how much money you will put into these assets, but how much excess return you will generate from putting money into these assets. You're saying, what are you talking about? So let's say you plan to invest $1 billion in new projects next year. That $1 billion has to come from somewhere, right? So that by itself is not going to add value to you. But if you can take that $1 billion and invest it in amazing projects that make 30, 40, 50% returns, when it costs you only 10% to raise capital, there is value added from those projects. I'm going to give you credit by giving you a value on those growth assets. But let's suppose you invest that same $1 billion in new projects. Let's say that it costs you 10% to raise capital for those projects and you make exactly 10%. There is no value in those growth assets. You will get bigger as a company, but you're not adding value to your company. The value of those growth assets can be zero. Take a third and perverse example. Let's assume you plan to invest $1 billion next year. It costs you 10% to raise that capital, but you think you can make only 5%. You know what? You will have a value for your growth assets on your balance sheet, but it'll be a negative value. You're actually destroying value as you grow. Already you can see that growth assets can have huge value for businesses that have tremendous growth potential and can earn great excess returns, might have no value for companies that are running in place, could actually destroy value for companies that are embarking on these pathways of taking investments that don't earn their required rate of return. This is something that we're going to focus on in both corporate finance and valuation, because to me the essence of running a good business is to make sure you create value from growth assets, and if you cannot find that value, you stop trying to create value from those assets. Let's talk about debt. You think that's easy. Just look in the balance sheet. The accountant will tell you how much you owe. If only it were that simple. It's true that bank loans and corporate bonds obviously show up on your balance sheet, but there are items that should be treated as debt that sometimes don't show up. For the moment, I'm going to leave that mysterious, but I'm going to give you 3 criteria that I look for to classify something as debt. The first is, with debt, you have a contractual commitment. A contractual commitment to make payments in the future. Remember, when you issue equity, you might tell people, I'll pay a dividend, but it's not a contractual commitment. If you don't pay it, you can't get sued for not paying it. But with debt, you have a contractual commitment. That contractual commitment can be to make a fixed payment, or it can be a payment that you've agreed to that's tied to something else. Floating rate debt, for instance, the contractual commitment can actually vary across time, but it's set up front. The second component of debt is that if you fail to make that contractual commitment, bad things happen. What kind of bad things? If you run a business, you could be shut down. The lenders take over your business. You default, you go bankrupt. And third, in much of the world, not all of the world, but in much of the world, that payment you make as a contractual commitment of debt, for whatever reason, the tax codes seem to be tilted towards it. They're usually tax deductible. Contractual commitment, tax deductible, loss of control. Those are the features that I look for to classify something as debt. And we'll talk about what, in addition to bank loans and corporate bonds, you might end up classifying as debt. Equity is a residual claim. What does that mean? You get to keep, so if you're the owner of a business, you get whatever cash flows are left over after everybody else's needs have been met. So you have to pay out the lenders, you got to meet reinvestment needs, you get whatever's left over. And remember, there might be nothing left over, or you might actually end up in the hole. Your residual cash flow could be a negative cash flow. It is a residual claim. If you shut the company down, you liquidate it, you first have to pay off your lenders before you get whatever's left over. If you're an equity investor in a publicly traded company, though, that residual claim is not necessarily going to come to you because there's an intermediary. That intermediary are the managers of the company who decide how much of that residual cash flow they will pay you as a dividend. So in a publicly traded company, what you see as dividends might be equal to the residual cash flow, might be much less than the residual cash flow, or might be much more. So keep that in mind when you look at dividends, that dividends are a smoothed out version of the residual cash flow, but they might not be a measure of the residual cash flow. So we've talked about assets in place, we've talked about growth assets, we've talked about debt, we've talked about equity. Now let me lay out a structure that I'm going to come back to over and over again in my sessions to introduce other concepts, and that is the notion of a corporate life cycle. Just like human beings are born, they age, they mature, and then they go into decline. Companies are born. That's what a startup is. They are teenagers. That's what a young growth company is. They're in the peak of their lives. That's what a growth company is. They mature, and then they go into decline. And the reason I like this structure is it allows me to think about how that financial balance sheet will evolve as a company ages. Let's think about it. For a young startup, if you think about the assets out of the balance sheet, almost all of the value is going to come from growth assets, right? What assets in place do you have? As you start to grow, your assets in place start to accumulate, but it's still the growth assets that drive your value. As you mature as a company, the assets in place are going to become a bigger and bigger component of your value. In fact, the essence of a mature company is most of your value comes from assets in place, less of it comes from growth assets. There will be a point in time in every company's life, though, where your growth assets are going to dry out. That's when you go into decline. All of your value comes from assets in place, and the assets in place themselves would start to shrink. There will be no growth assets. In fact, if you try to grow, you will only destroy value even more quickly. So the composition of your assets will actually vary depending on where you are in the life cycle. Now, if you think about the way you finance a company, debt and equity, that too will vary depending upon where you are in a business. No. So if you think about the composition of debt, of how you raise finance, if you're a young startup, remember, you have no earnings yet because your assets in place have not kicked in. The primary way in which you should fund yourself as a business should be equity. You cannot make interest payments with promise and potential, so you should be funded almost entirely with equity. As you mature as a company, you're a young growth company, you still are primarily growth assets. You should still be funded primarily with equity. It's as you mature that your capacity to borrow money will open up. And as your capacity to borrow money opens up, you might choose to borrow money. Why? Because remember, the tax code rewards you for borrowing money. And that will increase the proportion of debt that you have on your balance sheet. And as you go into decline, remember, you're liquidating your assets. You're going to be paying off both debt and equity. Your composition of debt and equity will reflect how quickly you liquidate. So notice the advantage of having a corporate life cycle is it gives you a sense of both how the asset side of the balance sheet will evolve as well as the liability side. So let's finish off with the harvesting side. You're saying, what's the harvesting side? I think we sometimes lose sight of the fact that the reason we invest in businesses is not to just see them grow. That's nice. But ultimately, we invest in businesses to collect on our cash flows. The end game here is dividends or cash flows. And if you look at how that side evolves as companies go through the life cycle, here's what you should expect. Early in the process, when you're a young startup, your cash flows are actually going to be negative. You're going to be raising capital to grow. As you grow, that will probably continue. You still need access to capital. As you become larger, you might not need capital as much, but you still might not be in a position to return much cash because much of your cash will go back into the business. As you mature as a company, your capacity to return cash will increase. If you're a publicly traded company, managers might still hold back on cash, at which point cash balances at companies start to accumulate. But eventually, that cash will start to return to investors when you're in decline. So everything about a business changes as it moves through the life cycle. And sometimes all you might need to understand why a business does what it does is ask yourself, where in the life cycle do I think this business is? So this is a concept we will return to over and over. But remember again, a financial balance sheet is forward-looking. It's simple in the sense there are only two items, but it's complex in the sense that those two items require that you know or you make your best estimates of what you think this business will do in the future. And how a financial balance sheet evolves will depend on where you are in the life cycle as a business.